Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to flip things up a little bit just because the EIA is delayed due to Columbus Day. So the EIA comes out on Thursday, and today we're going to do the economy show, and then we're going to follow up with the OPEC show coming out soon in terms of supply demand and where that fits. And then obviously we're going to wrap up on Friday with our Primary Vision Frac Spread Count. So in the econ show, we're going to do our normal daily indicator overview. The IMF provided some updates, so we're going to look at GDP. Then we're going to go a little bit deeper on the consumer, our favorite topic, and then jobs, and then wrap it up with what's happening in China and what's happening with Chinese trade now that we have some new data. And then that'll kind of build into what we're going to talk about with the OPEC show, especially on the demand side. So now just kind of jumping right in, here you can see the daily indicators because, the Bloomberg economy team does a good job putting it all together. And I think it really kind of paints the picture of what's happening right now. So here you can see China's, had a little bit of an increase now that you had the end of Golden Week. You have some normalcy coming back. We saw a big increase in imports, which was really more driven based on some stockpiling, not just in grains, but also in motherboards, chips, ahead of Huawei sanctions, which is going to create some strife. But those are things to watch to see if this is going to continue. And then exports remained elevated as we see more exports kind of pushing into different locations. Now, the bigger aspect when we look at the advanced economies, the emerging market economies, they continue to slow down. And the reason why that's going to be a problem when we start looking at, and we'll break out a little bit deeper, is the developed markets are the ones that are buying from the emerging markets. So if developed markets continue to slow, they continue to rely on stimulus. We'll go through what the central banks have done, where stimulus sits on different levels. But regardless, you still have the populace facing COVID increases, case increases, some hospitalization increases. This is just going to change the way people are going about their daily life, which is really showing up now that stimulus has really kind of priced itself completely out of the market. People have used it, and we're starting to see that appear in retail sales, same store sales. Some of that is continuing to slow, which again is just going to continue to weigh on this activity, which is just going to kind of pull down. So I would say developed markets, but pulling down emerging markets, which again is going to shift that whole global construct lower, which again relates to lower oil demand, which we'll talk about in the OPEC show. But that's why we still think that OPEC, IEA are still too aggressive on where they are on demand levels, as we see, jet fuel collapsing. We see airlines continuing to roll down. We see another October, Euro just took down October estimates again. Like there's going to be this continuing problem. And the reason why we talk about that is when we look at what expectations are. So the WTO expects global merchandise trade to fall by 9.2% this year versus 2019. Now, it expects a growth of 7.2% in 2021, but you have to understand that is not, like, as we look at percentages, it's going to be slower for longer. And we've already seen that. We've been talking about it aggressively in terms of trade. Trade has been our bigger focus in terms of, well, how deep is it? How bad is COVID impacting general demand? And here's where you can see the April forecast through the latest forecast. So April forecast, everyone was expecting this really big drop and then a quick rebound. And now we're seeing that sluggishness. And again, we've talked about how 2019 was a soft year. Coming into 2020, we were already getting bearish as we saw the Fed doing repo in October. We saw some from September into October, how those issues can continue to crop up. And middle distillate can continue to be really where we were looking at for that demand profile of what's the health of the economy look like. And again, middle distillate, that marine gas oil, that diesel really goes into power ships. So that's where that connection really comes back into play. So the bigger view is that, it's much weaker than the prior outlook for a 21.3% recovery. So now the recovery is only going to be 7.2% next year versus 21.3%. So just think of the delta in that, and that's where you start to see some of these estimates have to get revised. The slowdown is going to be prolonged through 2021, and that's why we're always looking at not only just what the World Trade Organization is saying, but what are the ships doing? Where are they going? How are they moving? Where are they moving? Or is there more of them? Is there less of them? These are key aspects, which then leads into what is the activity? What does the recovery look like? What can we expect? And this is why when we look at now the developed markets, you can see that things are really starting to roll over. The ones to really kind of key in on, and it's ones that no one's going to be surprised when I say this. Again, it's France, it's Germany slowing down again, but it's really France, Spain, Italy, and now the U.S. has seen a little bit of an uptick, which is a positive if you consider where we sit. But Europe is the one that's really starting to roll over, which is really impacting the developed market. So Europe, something that we focused on a lot last week. So I won't harp on that too much. But those are things that we think is going to continue to soften. And we have some data points which we'll touch on that kind of show how that production and how those miles driven, how the shoppers are really starting to react to the reductions, which is just they're the ones that are really kind of pulling down that developed market side of the equation. Now, when we look at emerging markets, again, it's always going to be an ebb and flow, and we're starting to see a lot of this balancing act where things are starting to roll off a little bit. India is kind of flatlined after they had that big rural surge, but that's something that we'll talk about when we look at Indian inflation as well as industrial production. And here you can see some of the others, starting to roll over. Russia, they are not. They're also seeing an increase in COVID cases. Some of the Middle East is seeing additional increases in cases. And again, cases are important to look at, but you really have to consider what is happening to the underlying infrastructure, hospitals, ventilators, those key infrastructure components, because that's really going to start to drive what are people going to do. The UK, France have talked about additional lockdowns, but as we've said multiple times over the last few weeks, you don't have the populist buy-in. You can announce one, that's great, but people won't listen. So, but even though they won't listen to a full-on lockdown, they will naturally adjust. So as they naturally adjust, the supply chain will be impacted, which again comes right back down to what is happening at the emerging market level. And that's where we continue to see more stress. And you can start to see things rolling over a little bit, starting to flatline, instead of being at, let's call it about 80 for developed markets, they're closer to that 70, 75 level. And we're starting to see that consolidation at those levels, which is just going to be problematic, especially as we consider what each country can do to try to stimulate their economy. And with FX reserves being an issue at emerging markets, where developed markets have more of an ability for stimulus, there's more, let's call it arrows in the quiver. Emerging markets are the ones that are going to continue to be a problem. And that's why we look at India industrial production when we think of the problem. What is the problem? What causes someone to take action? And here you can see the industrial production really started a flat line. It came in below expectations, that people were expecting a little bit more of a recovery, still negative, but a better recovery. And that's why we're starting to see that level off, where the outside of the urban areas, we had some resurgence, we had some more activity, which helped kind of propagate a bit more. But as we see those developed markets start to slow down, supply chains starting to backfill, starting to normalize a bit. Again, it's going to be different between small businesses and large corporations, which we'll touch on. But supply chains, for the most part, are starting to catch up, and that's starting to hit the industrial production from a lot of these originating countries that then send into the open market. The bigger issue is going to be inflation. So inflation is the one that you have to look at, especially at emerging market level, because central banks have to be cognizant of what is happening in my underlying economy. Can I continue to ease? Can I cut rates? Can I have some more monetary stimulus? Can I have fiscal stimulus? What is my currency telling me? And the inflation fears is going to be the bigger driver. Like if we look at Turkey, there was a run on the lira. There was an issue in terms of inflation. So what happened? The central bank had to raise rates. That's why then you have to start to see easing. And when does stimulus turn to austerity? And that usually can flip on a dime, really, in the emerging markets if you start to see a run on the currency, if you start to see doubt in a recovery or the economy. And those are things to really watch, because as we start to see adjustments in GDP, that's where we start to see some concern. So when we look at 2019, when we look at overall GDP expectations for 2020, they have gotten a little bit better. You had a relatively a little bit better August, a stronger September so far. But again, end of September into October, things started to soften. So at the back end of Q3, you had a little bit of a bump. Now going into Q4, you're starting to see some of that come off a little bit. So again, we think that there's going to be some adjustments to the downside, but again, not to the same level as where we were, because we're starting to see that kind of stability here. The bigger issue is going to be 2021. We continue to believe that 2021 is going to be a more depressed than I think what the market is predicting. We have the IEA, OPEC, a lot of these agencies starting to take down demand further, not only in 2020, but also in 2021. And when you look at the consumption of refined products, of oil, that really bleeds into, well, what is GDP going to be? Because again, this is going to be how are things moving, how are economies reacting, and that's where we continue to see a bigger problem. And the ones that we're going to highlight a bit more is going to be Germany, France, the U.S. obviously. So the U.S. had a little bit of an uptick. The New York Fed leading indicator had a small decline. Those are things that we're going to talk about a little bit later in terms of some of those key drivers. And then the ones that we continue to be concerned with is really Germany starting to roll back over. Again, not to the same level some of the other European nations, but Spain is going to be a problem. France as well, especially as we have those increases in cases. And that's why when we look at those different forecasts, again, we have China expecting China things based on some of their numbers. But the bigger issue is going to be, what are those bigger countries doing? What is going to be the bigger driver? And that's where we start to see some of these backdrops. Things are starting to slow down. Again, Q4 is going to be kind of that pivot point where we think things get a little bit worse than expectations, which is going to pull down some of those forecasts that we did see increase as Q3 came to a close. One of the bigger ones, especially, is going to be the UK. So the UK has its own issues with British exit, but it's also seen a big increase in COVID cases. They have an issue in terms of what's trade going to look like. And just based on the expectations, you're going to have to see a huge increase in growth in September. And if you just look at when COVID became a bigger issue, when trade started to slow, that September numbers essentially is going to be impossible to hit, which means that economic growth and GDP estimates are going to have to come down again for the UK, which I think is going to be something that's going to happen, peppered throughout the rest of the world, with the UK just showing you how important that trade is, that British exit continues to be an overhang. But again, stimulus is going to be fleeting in terms of what their abilities are going to be. Now, getting a little bit better in terms of what things are, this just looks at the annual GDP forecast. June, you had a little bit of an uptick that, let's call it 5.3%, depending on where things are. Second and third quarters were somewhat better than expected, but again, somewhat better is relative, especially as we keep talking about those leading indicators, those daily indicators. You're starting to see some of that rollover, some of that stagnation, which again is going to cause not only stagflation, maybe deflation in some areas, which we'll talk about specifically in Germany, which is going to weigh on just what these forecasts are. But just going back to 1980, you can see we've never really had this kind of GDP slowdown on this global level, which again is why the WTO, that trade, is so important to us in terms of, well, what does the health look like? What are things happening in the overall world? Now, when we look at that amplifying effect, so this is going to be slightly self-serving. So, we have the private equity energy infrastructure fund that we've started to go out and market a bit. And this is one of those key reasons why we want to look at that energy infrastructure, is because when you need stimulus, you need to do it in a way that's going to promote further employment, that's going to promote future growth. And that's where we start to look at output, private investment, employment. And that's why we start to look at where stimulus has to go, what work programs have to go into. And this is why we look at in periods of high uncertainty, in order to get that GDP boost, you need public investment in infrastructure. But the issue is the overall health of the tax revenue, the municipalities, the amount of debt already on those sheets, because when you think about the employment level, you want that multiplier effect. You want that percentage growth, because when we do come out of this and we start to see some adjustments on the long end, this is where we start to see these bumps. And now this is the public investment could generate between 2 to 8 jobs for every 1 million spent. Now, when you think about how some of these areas are stressed, you're going to have partners. You're going to have to go, and you're going to have municipalities, you're going to have governments look to partner with just other private equity banks, some venture capital, some other companies to co-invest in order to provide some of this growth in terms of electricity, roads, schools, hospitals. Like when we look at the creation of the interstate highways and just the way that really developed into such a huge multiplier effect because it streamlined the supply chain. And that's what we need to invest in now. We need electricity, so we need wireline, we need power gen. Roads. I mean, anyone who's lived in the Northeast can understand how tires, rims, and suspensions can go very quickly. And this is the bigger focus in terms of creating that ability to see that recovery and to see those job creations. Because instead of just giving people $1,200 and say, hope all is well, stay home. No, let's put them to work. Let's get them out there. And that's where you're going to start to see some of that growth. And that's why the uneven recovery is going to continue to happen, because when we look at the advanced economies versus developed economies, who has the ability to get those companies to come and invest? Who has the confidence? If I go in India, do I have to worry about inflation? How bad can inflation get? You don't have that similar overhang, though it may start, who knows, in terms of what could happen in the advanced economies, which is why we start to see some of this friction. But again, April, the assumptions were too lofty. June, they got dire, but now you're starting to see October, things have normalized a bit. Again, it's going to be somewhere between those June and October estimates, which is why we think that you're going to see that continued downward move, which is why we've remained concerned about oil demand and refined product demand. And that's where we start to look at those leading economic, start to look at current forecast versus June forecast. Things got a little bit better, but now we have COVID resurgence that's going to continue to weigh on kind of where things are sitting. But the bigger one is going to be India. So India, the June forecast, things got much worse based on the current forecast. That was what we called for, that India was going to get a bit worse. And those are things that we think are going to continue to materialize as you get estimates adjusting. And those leading indicators are really telling us that things are starting to slow down a bit more than even what our expectations were. And here, IMF still expects that 2021 bounce, but even that is starting to pare back. We're starting to see that slowdown in terms of, well, what is this recovery going to look like? How slow is it going to be? And here you're starting to see some of that get priced into those estimates. And this is something that we think is going to continue to see a little bit of a slowdown. Again, it's going to be a recovery. You're going to see something better, especially year over year. It's just not going to be at the same pace that the expectations were. And then what is the long-term effect? The long-term effect is going to continue to be that scarring. And it's really because how much stimulus can these countries continue to push out, which is why we look at some of those, where the lasting scars are going to be. They're in that developed market area. It's going to be in that slowing area. I'm sorry, not developed market, in the emerging market area, because they just don't have the financing. They don't have the foreign investment that continues to kind of pull out as concerns start to increase. And that's going to be that overarching overhang. Now, there's opportunity, in some of these countries, depending on what the criteria looks like. But it shows you on how there's going to be that lasting effect, which again comes down to why we think there's a slowdown, why we think this is going to be prolonged. And when we start off the next segment, we're going to look at, well, what is a K-shaped recovery, V-shaped recovery, L-shaped recovery, some letter of the alphabet recovery. The overarching theme is 2019 was weakening from 2018. 2020 was looking weaker than 2019. And then COVID came and just was jet fuel on that forest fire, which is going to really create that lasting impact, which again bleeds into oil demand and just demand in general for refined products, which is going to be problematic when we start to think about what does the next couple of years really do look like.